Hi everyone, how are you? Welcome to the presentation. That we're going to be talking today about sales tax and income tax opportunities and risks post Wayfair. Now, why do we choose this topic? Well, after the Wayfair case was decided, we spent a lot of time speaking about sales and use tax. Now, what we wanted to do is give some updates a couple of years later on how the companies are handling the Wayfair case to date, and we want to include income tax as well. And we'll be covering quite a bit on the income tax side as well. Now, we're going to be, throughout the presentation, we'll be discussing both risks, which are obvious, and some opportunities as well that we've been finding out there in the marketplace. Now, with the current pandemic wreaking havoc on the state revenues, we thought it was a good time to discuss this topic in detail. So, but first, let's talk about, let's do some introductions. So I'm Jim Bartek. I'm a partner in helping lead the state and local tax practice at Witham. And I do have significant experience dealing with sales and use tax and income tax matters and helping clients deal with this mess we're about to talk about. Jason?
Great, thanks everyone for joining. I'm Jason Rosenberg. I'm a senior manager based in the New York office. I have over 10 years experience advising clients in multi-state income tax, working with a number of different industries from manufacturing, retail, bioscience, technology, and so on. I'm glad to be here. And Bonnie?
Bonnie?
Yep. Welcome everybody. I'm Bonnie Susmano. I'm a tax supervisor in the New York City office, and I've got over 10 years of sales and use tax experience working with, like Jason, companies in many different industry areas.
Okay, so what we're going to talk about today is we're going to start with the current climate of state and local tax and basically show you that states have been struggling with this, and we'll talk a little bit about each area, sales tax and income tax as well. Then Bonnie will talk about Wayfair 2 years later. Just a recap of what Wayfair is for those of you that may not know. And then of course we'll talk a little bit about Marketplace Facilitator with that as well. Then Jason will talk about the impact of Wayfair in the realm of income tax as well as planning opportunities with market-based sourcing. And then we'll summarize with what companies should do at the end. Of course, at the end of the session, time permitting, we'll be doing some questions. We will stay around to answer some of the questions. Okay, so basically one of the questions I ask when we're usually live is, let me know which state you think gets the worst rating for business climate. And then I ask, what is the best? So if you can imagine, if you're from the state of New Jersey or New York, this area, a lot of our states have consistently got the worst ratings in the nation, like with New Jersey at number 50, which is basically rating the New Jersey business climate, which takes into account all of the taxes on business and personal. New York got number 49 and California number 48. Now we do have great schools here, of course, so again that helps. Now the best states wind up being Wyoming, which is number 1, South Dakota number 2, which both have limited taxes, mostly rely on a sales tax there. And then of course you'll see Florida down at number 4, Texas at number 13. So again, and again, normally in person, I will ask, well, what is the biggest source of revenue that states have? And a lot of people do guess this right, is individual income taxes, which make up about 40% of revenue that states rely on for their income. Of course, you have property taxes, although most property taxes are local. Consumption taxes, which are like sales taxes, make up quite a bit. In some states, as much as 33% or so, or it could be higher if that's the only tax they have. Now, if you see here, corporate taxes are only 4.4%, but if you're a business person, you realize that that does take up a huge chunk of your time, working with compliance on the income tax side. Now, overall, due to the pandemic, the state revenues were down quite a bit, especially early around the beginning of the pandemic. But basically, they have recovered quite a bit in the last quarter. If you were watching the news yesterday, you saw that the GDP was up 33% from the past. So overall, it's only down about 5.6% total revenues. Now, property taxes are still stable for now. Of course, as we see defaults and so forth, maybe that will change. But individual income taxes actually dropped about 10% year over year. Of course, there was some due to the timing and the sluggish economy. And again, most states, their fiscal year does end at the end of June. Although if you're from New Jersey, you're aware that the New Jersey did extend it to September. So that being said, in the next few years, we do expect states to face a tough road ahead. And we do expect they'll be aggressive in auditing and monitoring, especially if you have online businesses, as that has pretty much helped save the state's revenue sources as Wayfair was implemented, and Bonnie will explain a little bit more about what that is. Now, keep in mind, there was a very strong 2019 and beginning of 2020, which kept some of those losses down. Now, how high are sales taxes in your state? Here's a chart with average sales tax rates. As you see, New York is number 10, New Jersey number 30, Florida number 23, Massachusetts is number 35, California number 9, and Tennessee is number 1, meaning the highest average rate at 9.53. And some of those rates could get out over 10% as well. Now, as you can imagine, as states issued the stay-at-home orders, the revenues went down. So there's a sharp drop in sales tax collections. But they did increase dramatically over the last quarter and closed down pretty low, which was under 0.5% decline for the sales tax overall. And a lot of that is due to the Wayfair case. If these states did not implement the laws, they most likely may not have had that revenue gain. A lot of companies also who were traditionally handling things in person, like could be services in person, like training classes or so forth, did convert to online as well, which again, businesses being savvy found a way to prevail in this economy. Now, New York still fell, by the way, to about 9.5% during this past quarter, which ended September, which is their second quarter. Their year end is ends in April. So again, so year over year fell 9.5%. With the second quarter alone, meaning the one that ended in June, was a 27.1% decline. New York City, by the way, was a 22% decline, as obviously it wasn't much tourism in the city, as well as restaurants being closed. Now, how high are the corporate income tax rates? New Jersey at 10%, PA 9.9%. Now, South Dakota and Wyoming, there's nothing there, as you'll see. So again, very small. Now, Texas, as you'll see, has none, but they do have franchise taxes and other taxes, of course. Now, corporate income tax did drop 17.5% year over year. Now, it only accounts for less than 5% of revenue, but as I explained, it could be large for a lot of corporations. Jason?
Yeah, and so, reference to gross receipts taxes and other type of non-income taxes within the realm of business tax. So, these are often described as very cost prohibitive because it really does impact businesses with low profit margins and, high production volumes, as well as, growth companies that might be in losses could still be subject to a gross receipts type of tax. Oregon is one of the latest states to enact such a tax, but what's unique about the Oregon gross receipts tax, what they refer to it as the CAT tax, is that other states that have it, like Texas or Ohio, it's in addition to the income tax that's already in the state. So essentially, Oregon didn't replace the income tax. They didn't repeal their income tax. They just added another layer of tax, completely separate regime. It's been described as a hybrid of the Ohio CAT tax, the gross receipts tax in Ohio, and the Texas franchise tax. It has features of both of those. So, just something to keep in mind that even if you're in losses, there are states out there like Nevada, like Ohio, like Texas, Washington, and Oregon that do have gross receipts taxes.
Yep, and in cities as well, right? So you got a lot of cities nowadays like San Francisco, Seattle, LA. Just keep that in mind as well. We could see the trend of gross receipts taxes in the future. Now, rainy day fund, these are budget stabilizing funds for use in unexpected deficits. As you can see, PA and New Jersey, 1%, whereas some of the other states like Wyoming and Alaska have larger rainy day funds. Now, this was back in May, this chart for states project large pandemic-related revenue declines. Now, obviously, New York ended their fiscal year ended earlier this year, so that's why their fiscal year 21, and California and Illinois. A lot of states are projecting, like Massachusetts, Michigan, both years. Now, this was back in May, and obviously these have been updated since then. Now, with the income tax, you'll see on this chart, you'll see individual income taxes are expected to lower quite a bit, more so than sales tax as well as corporate tax. So the states are bracing for that. They know that they're going to be, like I said earlier, they might be auditing quite a bit. Now, Governor Murphy signed a bill to use 4.5 billion of debt to plug a hole, so that they understand that that may be a situation coming up as we potentially go through further lockdowns in the future. Now, as I mentioned before, New York overall revenue for sales tax was down, and overall revenue is about $28 billion or $2.8 billion lower. Although in the next 4 years, they do expect a $60 billion potential hole in their budget. So again, something to keep in mind as you're moving forward. Now let's go to our first polling question. Do you think states will be able to grapple with the projected tax revenue shortfalls? Okay, you can see the answers here. There we go. Okay, 33% of you, it's as it's moving along, 68% of you think it's poorly. They're poorly going to grapple with projected revenue shortfalls. So again, there's no wrong answer here. Again, some do think they will meet the challenges unless further economic downturn. We move on. Okay, so this chart, how have your state revenues changed from fiscal year 19? Again, these are fiscal year numbers. So obviously you see New York up there at 8.1% decline. New Jersey was relatively flat, but again, there's numerous reasons for that. And one being they extended their deadline, but number two is, of course, they plugged the hole. So again, it depends on how you count revenues, but again, overall, I think states were down about 5.5% in the fiscal year. So again, it remains to be seen how the states will handle it, and may depend on what they receive from the federal government. Okay, and as I mentioned, one of the ways the states can fill some of these thresholds is, or these pitfalls in the revenue, is Wayfair, using the Wayfair case and the Nexus laws and so forth. And Bonnie is going to discuss both physical nexus and economic nexus. So Bonnie.
Okay. The big question that keeps buzzing everywhere with clients is, what is nexus? And nexus basically is just a sufficient connection to a state that allows the state to require you to register, collect, and remit tax. Specifically, I've noticed this on calls lately because a lot of clients don't know about Nexus. They're like, where does it come from? How did this even start? So basically, when you think of Nexus as a connection to a state, you would realistically think about payroll and property. And that came about in 1992 because of the Quill case, in which a remote seller of office products was shipping goods into North Dakota. And so North Dakota said, hey, you owe sales tax on those sales. But the Supreme Court said, no, they don't have a physical connection. They don't have a real connection to the state. So fast forward now to 2018 when Economic Nexus came out with Wayfair. And with Wayfair, the online furniture store, in case you're not familiar, South Dakota said, Wayfair, hey, you owe us sales tax because you're making all these sales of furniture into our state, and we're not getting any of the sales tax revenue, and you're hurting our brick and mortar stores. So the Supreme Court said, we agree with you. And they overturned Quill. So in addition to physical nexus, now there's a requirement that if you hit certain economic nexus thresholds, you were required to register, collect, and remit sales tax in South Dakota and everywhere. So what's also interesting to note about these cases is that these cases came out from Quill was North Dakota and Wayfair is South Dakota. So it's interesting how they challenged the court system and how it wasn't New York or California, which is what you would typically think. So the other thing that the Supreme Court also, I wanted to mention, noticed is that Quill was creating market distortions because, like I said, the Supreme Court back when Quill was decided said, hey, we've got to, we don't have to level that playing field. You're a remote seller, you're not in the state. But Wayfair, they said, no, we're leveling the playing field with our brick and mortar stores. So it's interesting to note that back in 1992, less than 2% of Americans had internet access, and today it's approximately 89%. And I'm sure everyone's seeing that now with the coronavirus, everyone's ordering things online. So now, like in 1992, mail order sales were approximately 180 billion, and now they're over 453 billion. And in addition, back in 92, the states were losing revenue, right? Because all these retailers could ship into the state and they couldn't collect the tax. They were losing about 694 million to 3 billion per year. And because of the physical presence requirement, and the current range is now between 8 billion and 33 billion. So just to give an overview, approximately 42 states now have enacted, plus DC, have enacted an economic nexus type standard. 5 states don't have any sales tax: Oregon, Alaska, Montana, and blanking out on the 5th for some reason, and New Hampshire. So that
Delaware.
leaves, oh, Delaware. Yes, you're right. Thank you. I'm like blanking out there. So there are 3 states that don't have economic nexus standards. In Florida, the governor doesn't support having any law enacted. In June, a bill was introduced in Kansas, and there seems to be some internal conflict in Kansas because when you talk with the department, they'll say, yeah, we have a certain threshold going, and the Attorney General said, no, we can't enact a law. So from our perspective, we view it that they've got a threshold. In January, 2 bills were introduced in Missouri to enact economic nexus, and currently they have not been passed. Also important to note that increasing number of states are changing their services from non-taxable to taxable. And a taxpayer's revenue stream may be taxable in their home state, but may not be taxable in another state. And an example of that, which we're seeing a lot, are these online sellers using selling SaaS, software as a service, and that while it's taxable in New York, it's not taxable in California, and it's not taxable in New Jersey. So we're seeing a lot of clients initially not understanding why it's taxable in one place and not another, and it's just that some states chose to tax it and some states didn't. So this is a map showing which states have adopted economic nexus, which we discussed before, 42 states plus DC. And as you can see, Oklahoma has a reporting requirement as part of their economic nexus standard. In addition, Alabama has an economic nexus standard, and also a reporting notification in limited circumstances. And then we also show the 5 states not imposing sales tax, and Missouri and Florida, which have not yet adopted an economic nexus standard. So the reason that this has become very confusing for most of our clients is that economic nexus is, the thresholds vary amongst the states. And most states have a 2-pronged threshold, in which it's generally, it varies by state though, 100,000 and 200 transactions, both have to be met. Whereas there are some states that use disjunctive language where it's 100,000 or 200 transactions. So like Connecticut and New York use that and requirement, whereas most states use or. In addition, some states have amended their economic nexus threshold since 2018. For example, the threshold in California was 500,000 with no transaction threshold, and then previously it was 100,000 or 200 transactions. In addition, New York in 2019 went from 300,000 to the $500,000 threshold. So even from 2018, we're seeing different states change their thresholds. So the reason economic nexus really also came about is because of remote sellers, all the online sellers like Amazon. And so a remote seller is often thought of a company selling their goods and services on the internet, and those companies don't necessarily have a physical presence because their sales can be done through online sales, purchase orders, phone orders, catalog orders, and an automatic replenishing system in which it's just automatically reshipped monthly.
Okay, one thing, as Bonnie mentioned, I mean, there's a lot of companies that could be a remote seller. Anyone like a manufacturer could be a remote seller, of course. As companies are opening e-commerce sites, we see a lot of that, and maybe taking some business back from Amazon for that matter. We were just talking to a company that was selling towels and previously only sold through Amazon and Walmart. And as Amazon and Walmart, they were either selling them for resale or selling it through their system as a marketplace seller, which I'll talk about in a second. Now that they're taking the business in-house, they may become that marketplace seller, right, where they're going to have to collect sales and use tax if they pass some of these thresholds. Now, there was a question on here, are sales that are exempt, including when determining economic nexus? That depends on the state. There are some states that say sales to Amazon, a lot of the states say that's included in the entire amount. Some states say that it's not included. Okay, so you have to, it really depends on the state. Obviously, you can always contact us if you have a question separately, and we'll talk about that. Okay, we'll move on to the next one. On the Wayfair and technology companies, again, there's a lot of people think it only applied to technology companies. And it did affect technology companies quite a bit due to delivery methods of the technology-related services, as they were pretty much delivered either electronic download for sales for software, or software as a service, which was hosted on the seller's website. Now, again, some companies may not know they're actually a tech company, like they're selling online. Like I mentioned before, there are companies coming up with creative ways, such as online training or education if they were in that business, because you couldn't meet in person, like we're doing right now. We're not selling this, but we're doing this. This would normally be in person. Now, plenty of states do tax digital products, which is very ambiguous. Bonnie and I were just working with a client on determining whether their training services were subject to sales tax. Again, very ambiguous across the states, not a lot of guidance on that. Now, it's obviously a competitive edge for those who you can help your clients source your sales to them properly. Like, for example, there are many states that don't tax software if delivered electronically or via software as a service, and based on where it's used, that could create opportunities if you're able to help them and limit their sales tax. Okay, other industries, of course, we talked about retail and remote sellers, media as they sell new services. Software could be added. Healthcare, again, we've seen some digital services as well. Financial services, we were just fielding a question on bullion, but also some states could tax bank services. So if you're selling into those states, could be taxable. Not-for-profits, a lot of people don't realize that not-for-profits, that sales to users out that are not exempt, like selling something to me, would be taxable if they have the obligation due to Wayfair to collect. They must collect, register, collect, and remit sales tax to the states. And private equity, M&A, due diligence, and so forth. We're doing quite a bit. Now, bottom line, this Wayfair was one area where we did have a lot of bipartisan support, as again, it's not a tax increase for the Republicans and the Democrats. We were able to collect quite a bit more money for the states. Now, foreign sellers, a lot of arguments on whether they have the U.S. states have the ability to go after them. There is some ambiguity there. If you're an inbound company selling something that's taxable, you should definitely do an analysis and determine whether you should be collecting or remitting sales tax. And then some other considerations. Bonnie mentioned notice of reporting requirements to taxing authorities, but also marketplace facilitators. We mentioned that many of the states have enacted, the same states that enacted Wayfair have enacted the marketplace facilitator rules. And what this means is companies like Amazon, eBay, and Etsy, like that, they are marketplace facilitators. So they have the obligation to collect sales tax on behalf of the sellers. Okay, so if you're a company selling on Amazon, and it's basically Amazon will have to collect the sales tax on your behalf. So again, it's another reason why states are better in better shape on the sales tax end. Now, one thing is on the inventory side of it. Keep in mind that if you have Amazon or another company handling your inventory around the country, that could create physical nexus for you in many different locations. And then it's been becoming a common practice for payment processors to realize they may actually be responsible for collecting the sales tax. They may fit within that marketplace facilitator role. So again, if you have an app or so forth that's booking hair appointments, for example, and they are collecting the payments, they may be responsible for collecting the sales tax. Now let's go to polling question number 2. And overall, do you feel businesses have been generally compliant with Wayfair? Yes, no, not sure. Haven't considered Wayfair as 2020 has been tough enough. Okay, I'm waiting for the others. So we're getting answers in. Okay, we need more votes here. Okay, so we got a good mix, and you're absolutely right. Is some companies have taken care of Wayfair, most have not. Like what I would say is, obviously, even if you have, you need to do a health check every year on sales tax and income tax side, and as Jason will mention on the income tax side in a second. But of course, there are a lot of companies that have not addressed it whatsoever as of. But again, no time like the present. Jason. And you're on mute, Jason.
Yep. Thank you. So let's discuss how this all affects income tax, right? So, when we think about Wayfair, the first thing what we need to do is really take a step back in time. And as Bonnie mentioned, right, as we know, Wayfair overturned Quill, which is the 1992 case requiring physical presence for sales use tax. When the case was decided, the court ruling said to the effect that they did not review or articulate the same physical presence requirement that was established for sales tax, which would not necessarily imply the rejection of physical presence rule for other tax types, which really left things open-ended. And many tax practitioners at the time questioned, was there really that same physical presence standard for income tax that Quill had determined back in 1992. So some states started to grab hold of the ruling back from 92 and interpret this to mean that since the court didn't opine on the physical presence rule, right, applying to other tax types, that it wasn't a requirement for income tax, which really opened the door of a gradual process of states asserting economic income tax nexus standards into practice, and which we often see this today through either statute, case law, or interpretation. So unlike sales tax, which economic nexus really came about overnight from the Supreme Court ruling in 2018, with Wayfair, for income tax, this really has been a gradual evolution over the past few decades. And then next slide. Perfect. So, with that being said, right, we have this Jeffrey case, which is a state case, and the start of this economic nexus movement is often harkened back to this South Carolina case, where it was determined that a taxpayer had established nexus, even though the taxpayer lacked physical presence in the state, but its licensing of intangibles was deemed sufficient in establishing nexus. So the U.S. Supreme Court never agreed to hear any of these cases regarding economic nexus for income tax. And although initially there was some uncertainty if it was even constitutional, as these cases were going through, at the state level, and then states gradually enacted more economic nexus standards over the 20 plus years without Supreme Court involvement. And it became more and more accepted as commonplace over the years. Again, one of the primary concerns with sales tax economic nexus was the compliance burden with all the different reporting jurisdictions, which really was less of a concern with income tax. And so economic nexus is just now, commonplace and accepted now that, Wayfair overturned the physical presence standard for sales tax. So, just the important key takeaway is that Wayfair, although certainly affected sales tax with economic nexus, for income tax, you can see that economic nexus has been on the books pre Wayfair decision. So moving on here. So I like this slide. So you can see, right, up to 2018, only 10 states explicitly stated that they had physical presence standard for corporate income tax, meaning that essentially, there were 32 states with economic presence, right prior to the decision here. So all what Wayfair does for income tax is really, it validates economic nexus, and allows audit divisions to increase enforcement of nexus provisions. As economic nexus is considered to be constitutional for the past couple of decades for income tax, and it's been on the books, issues like retroactivity does not come into play like it would for sales tax. So again, considering that economic nexus has been codified in many states prior to Wayfair, Wayfair just reinforced these broad doing business statutes as the law of the land. And then moving on here. So just kind of as a recap, you can see in the first column, right, pre-Wayfair, for sales tax, physical presence was the law of the land, as I mentioned, and affirmed in Quill. And for income tax from 93, states continued to broaden their economic nexus standards, and many states joined the economic nexus frenzy. However, each state asserted nexus differently, and their aggressiveness with nexus also evolved over the years. And then post Wayfair, as a consequence, most states actively establish economic nexus thresholds for sales tax. So in addition, states have adopted economic nexus standards for income tax, which many states have enacted, pre-Wayfair, as I mentioned. And, many states use either broad doing business standards or bright line tests, which we'll take a look at in just a moment. But, at the end of the day, right, the impact, with the budget shortfalls and everything going on with COVID, we expect states to continue to aggressively pursue the enforcement of economic nexus. Okay. So what are we seeing from states post Wayfair, right? We're seeing increased audit activity on economic nexus. We're seeing a lot of nexus questionnaires and audit assessment notices are being received by many businesses, which usually trigger an audit depending on how they're responded to. So they're super important. And a lot of VDA programs where that sometimes we'll go to a state anonymously to negotiate and try and mitigate some historical exposures. So the key takeaway here is that the landmark case had a far-reaching impact, but along with the expansion of Nexus, really now comes the time to plan for opportunities for both income tax and sales tax. So, that's what we're going to go into next is how do we now deal with, all these states trying to tax all, these businesses? How do we try and maybe mitigate some of this, in terms of the nexus? So let's move on to the next slide. Oh, we got poll. So have you considered economic nexus for income tax?
Okay, we got a few more seconds, Jason. Okay, Jason, we got about 51% said yes after Wayfair I did, and 22% no, and 28% yes before Wayfair I did.
Yeah, so Wayfair definitely brought economic nexus to the limelight for income tax, even though it's been on the books. So just making sure something to think about, because many states, we've seen it, are very aggressive in inserting economic nexus for income tax pre-Wayfair. And so again, it's very important to consider how do we best plan now going forward, given these broad-based nexus standards. So with that, let's discuss market-based sourcing and just some planning considerations when it comes to nexus, because again, number one, nexus, right, is just a filing requirement, but it doesn't necessarily equate to taxes. And so what is market-based sourcing? Right, so as part of the sales factor of the apportionment, right, when we calculate state tax, the adoption of market-based sourcing has been one of the most significant trends in state income tax in recent years. Conceptually speaking, market-based sourcing assigns sales, right, revenues based on the location of the customer or where the customer receives the benefit of such services. Right, so the state's rules to attempt to identify the marketplace location for the service location, right? So, however, there's going to be countless sourcing rules and variations across jurisdictions that often lead to subjective sourcing application. So, for a service provider, market-based sourcing can expand business income tax nexus. And so, for service providers, nexus studies have become more of a sales sourcing exposure study, opposed to a traditional nexus study where we're just looking at physical presence. So moving on to the next slide, with apportionment, right, let's start here. So in order to determine how to compute taxable income in any given state, which probably seems easier on its surface, it really requires significant examination as each state has their own rules. And when we think about that, we look at the different factors, the different components that are used in calculating the apportionment. And traditionally speaking, you'd have payroll, sales, property, right? But there's an increasing reliance now on the sales factor. And in differentiating revenues of tangible personal property versus services, it's really important to be cognizant of how sales from services are sourced. For service-based companies, the generic rules of market-based sourcing are right. There's under the methodology, there may be multiple different approaches. And today we're just going to focus on market-based sourcing, as that's the current environment, and it's been the adoption and movement from cost to performance sourcing, which you can see on this slide. Right, you can see under services, there's two different main methodologies. And today we're going to talk about market-based sourcing, as that's been the national trend for most states to have adopted and moved towards. So let's move on to the next slide. And then, with market-based sourcing, the other trend is the move to the single sales factor, which, the purpose is to really just export the tax and put the onus on an out-of-state company opposed to an in-state business. Because essentially when you use property and payroll as part of an apportionment factor, right, that really hurts an in-state business, because as part of the factor, part of the apportionment calculation, you're looking to the employees of the state, you're looking to the property within the state. When you remove those two factors and you only use a sales factor, right, under market-based sourcing, you're looking to where the customers are. So if you have customers out of state, right, your home state, your within state where the company is based, isn't necessarily going to be taxing you anymore. So really what these national trends are really, the politics behind it is, taxing out of state businesses opposed to, taxing within state businesses. So that's really what the national trend is with some of these legislation that's going on. So moving on to the next slide here. And you can see with this map, right, most states have adopted single sales factor as of 2019, really making the importance of sales factor sourcing and understanding all the nuances just that much more important, right? The reliance on a sales factor has just significantly increased when you remove payroll and property out of the apportionment factor. So that's going to increase the emphasis and really just makes sourcing planning super, super important. And let's go on here.
Another spot check. It's will you be willing to pay higher taxes due to the to reduce the state budget deficits? Yes, no, heck no, or only for more state programs? Oh boy, overwhelmingly heck no so far, Jason. We still have some time though.
A couple of people said yes, I think.
Okay, so it's 57% heck no so far, and 7% did say only for more state programs, and 11% said yes. Wow.
Funny, we asked the same question to a bunch of CPAs, and a lot more said yes. Okay. Let's move on here. So let's talk about market-based sourcing here, and we'll talk about some examples, right? So market-based sourcing statutes are very broad, and how to define the market results in a lot of unanswered questions. And it's ambiguous, right? At least but the ambiguity leaves for planning and state tax optimization. So we need to be asking ourselves, should we simply be using the billing location of our customer, or is there a more accurate way to source the sales to a state, right? And I know a lot of our businesses, they'll send over their sales by state on a billing address and, a billing address location. And, that basis might be right in some states and might not necessarily be right in many other states. So, defining where the customer is located can present its challenges. So let's use an example, right? Let's say we have a company that's in the business of offering third-party or outsourced customer services. And let's say this business provides customer service activities on behalf of its customer. Let's say a car rental company. And it, provides those services directly to the car rentals company's customers. So for simplicity, let's use Hertz as an example, right? Is the benefit of the customer's service relations truly received at the customer's billing location of Hertz, right? So let's say Hertz, their accounts payable office, maybe let's say is in New Jersey. Do we just, source the receipts to New Jersey? Or let's say Hertz corporate headquarters is in Florida. Should we then source it to Florida or Jersey, right? Or let's say the customer service company engages primarily with Hertz through Hertz's customer relations department in providing the services. And let's say Hertz's customer relations department is in Iowa. Do we source the sales, the receipts to Iowa? Or maybe the market benefit of the customer service that our business might be providing is based on, should be sourced of all of Hertz's locations, right? They're obviously in all 50 states. So should we source based on all these car rental locations and just divide it based on the number of locations per state? Or do we, should the business consider intermediary type of rules where that the benefits truly received at the ultimate customer, right? So not the business's customer Hertz, but maybe Hertz's customer, the customer's customer, right? And let's just say maybe that's the right approach. Would we know where those customers are? Do we use maybe a census type of approach? Or do we track, maybe based on phone calls coming into the support center, right? Do we source on that methodology? So certainly each business has their own set of complicated facts like this, without a doubt, because we go through it every day. And they have different revenue streams, and each state has its own set of statutes, regulations, guidance, and no one answer is necessarily correct. And it really does require, sourcing analysis on a state-by-state basis based on the sales revenues that are at play. And this really leaves for planning opportunities, because if significant tax is being paid, let's just say in New Jersey, because you're sourcing to the billing address being used, or significant tax is being paid in Florida because of a headquarter sourcing position that's being used, right? These sourcing methods should really be examined. And also the vice, looking at this on the flip side, right, is potential exposures. So again, as mentioned, the states have very complex sourcing rules. They're ambiguous. Many states have draft regulations. For instance, New York had passed corporate tax reform back in 2015, and their market-based sourcing regulations are still in draft. They haven't finalized them. And so that makes for a lot of leeway, depending on the facts and circumstances, and potentially putting forth different arguments. And let's move on to the next slide here. So it's a little complicated, but let's look at it super high level as an example. And you can kind of see some of the complexity, right? So this is the statute in California. And California says you have to source to California to the extent that the purchaser of the service received the benefit of the service in the state. And then it goes on to say that the benefit of the service means the location where the taxpayer's customer has either directly or indirectly received value from delivery of that service. Well, what does directly or indirectly even mean? Do you look to your customer? Do you not? Right? It begs for a lot of questions. And California does have some guidance on this, and it really is fact specific depending on the type of services and a lot of different other variables. And so it's very important. The bottom line is, it's very important to understand the revenue streams, understand the specific state case law that might be out there when we're thinking about sourcing. So moving on. So with market-based sourcing, again, right, it's important to consider, are you making sales to a business customer or a non-business customer, right? Just based on that, you can have completely different sourcing results. And you might have a tax in the state and you might not, based on that sourcing approach. It's important to note that states might apply hierarchy or cascading rules, which we'll take a quick look at in the next slide. And where that the market location is presumed based on a set of rules, but certain presumptions are sometimes made, and you can overcome them. So you can see in the next slide here. Here we go. You can see in this slide. So some states will put out a cascading set of rules to say, the benefit received in the state, and if you can't figure out what that means based on their guidance, then you go to the second step. Then they talk about delivery destination. If you can't figure it out, you go to step 3 and 4 and so on. So, and then, you can overcome some of these presumptions. So the bottom line is that sourcing gets complicated. The good thing with it is that there's a lot of opportunity because of the complication and because it's ambiguous. And so that's why, sometimes it makes sense to use a billing location approach, or sometimes it might make sense to use a headquarter location approach. But sometimes when you're paying a lot, significant tax in the state, it might pay to do an in-depth analysis to say, what, does this make most sense? Based on the case law out there, is there a better position? So that's really what we're trying to do here. And then moving on. So real quickly, again, the benefits is that with market sourcing, it's more aligned to the intended purpose, the sales factor. It may favor in-state businesses. And then if we look at the next slide here, some of the limitations is that states have different mechanics in defining the term market. It's very complicated. It's difficult to determine where's the benefit really received. And so again, the key point here is to keep in mind that market-based sourcing, it hasn't been out that long. Generally, most states started to really adopt it the last decade. So these statutes haven't been on the books long, and so there's not a lot of case law out there. So again, sometimes we come back and we say, it's ambiguous. There's not enough guidance out there, but let's see if we could come up with a position that might be sufficient. So, going to the next slide here, just as a quick reminder, if anyone's not familiar with this, but there is federal law, and should mention it in reference to Nexus, is that for a business that does sell tangible personal property, right, and its activity in a state does not exceed the solicitation of sales, there is federal law protection that potentially prohibits a state from taxing income tax. So there is Public Law 86272. It is out there, and just want to make mention of it quickly. Let's go ahead here. And with that, I'm going to hand it off to Jim just to help kind of wrap this up, and then we'll take some questions if there are any.
Okay, sure. So, again, let's get practical. What should companies do? And just to remind you, right after I get through this, we will be going through some questions that have been coming through online. If you see me looking off, that's what I'm doing, is looking at some of the questions. So quickly, what do we recommend to our clients? Review the existing and post-Quill, so it'll be Wayfair Nexus footprint. So you really you need to review your existing filing requirements pre-Wayfair, because you might have some liability. Maybe you did have Nexus in the jurisdictions. And then of course you have to assess your post-Wayfair filing obligations. While you're doing that, you want to evaluate your income tax and other Nexus as well. And the reason you want to do that is if you just say that you do have Nexus for sales tax or income tax, so vice versa, and you register or start filing returns for one or the other, the states may say, well, why didn't you do it for the other? Okay, so just very important to do that. We do recommend that you do that at least annually. Even if you've performed an economic nexus study last year, we did see a big uptick in sales this year, especially online businesses and so forth. So you may have passed some of the thresholds in certain jurisdictions. So again, keep in mind you need to update it. As I mentioned, you need to determine your potential exposures. There are savings opportunities there, voluntary disclosures, amnesty programs. We've had some great deals on voluntary disclosures in the past 6 months or so, just because we've identified it. We came forward with the state. We worked out deals with them. They were pretty agreeable to get some money. They were very happy, as a matter of fact. For sales tax, the savings opportunities, of course, you got to determine the taxability of services. You might have some positions where your services are non-taxable. We mentioned training services, a lot of ambiguity there. We've gotten some interesting answers across the states, a lot of diversity with the answers. Consider your sourcing positions for both income tax and sales tax. So even if you have some potential exposures on the sales tax side, maybe you can source them outside the state. Same thing with the income tax side. Is if you work with your clients, you might be able to find some interesting information. Analyze the 86272 filing positions, as Jason just mentioned. Again, there might be some positions where you do not have a filing obligation. And then, of course, identify sales tax erroneously paid to vendors as some vendors we see are being very conservative in collecting tax. They don't know whether it's taxable or not. They're going to charge tax. So you could find some savings opportunities on refund claims. And then again, reducing the exposure by negotiating the economic nexus start date. There are some states that have some bizarre rulings on that, on when the actual date started. We've had success arguing that as well. And I already mentioned the VDAs. So the next slide was consider the overall business implications. Don't forget this. You need to focus, talk with the stakeholders. If you're going to start charging sales tax, you got to involve legal, marketing, supply chain, technology. Make sure all those departments are involved. It's not a lot of businesses. You can't just turn on the sales tax and start charging it. There's over 10,000 taxing jurisdictions. If you may need some software out there. So again, next one was bullet was technology needs. What do you have and what options are available? Considering tax engine updates. There's software out there with the sales tax rates. And then of course, compliance. Once you do this, you have to comply. So both on the sales tax and the income tax side, very important to make sure you have all that planned out before you start registering for the states. And then of course, review the structure and the revenue streams. You need to analyze your structure for the income tax purposes. And for sales tax, develop a taxability matrix, determine a tax base, make sure you're not bundling transactions which are both taxable and non-taxable. And then, of course, you want to prepare for increased audit activity. As we mentioned, the states are having a tough time with revenues. We do expect they're going to be sending out notices. A lot of states have been to a lot of our clients. We mentioned compliance. You're going to have to register in new jurisdictions, either through a VDA or regularly. And then monitor the tax paid to vendors and make sure you're collecting exemption resale certificates. And then finally, of course, monitor tax updates and handles tax audits. As we said, you have to stay abreast of the tax updates, as many states have changed, as Bonnie mentioned earlier. That being said, let's go to some questions and comments. So I'm going to read some of the questions. So one of the questions was from Robert, said, can you address the extent to which the provision of professional service subject to sales tax and would be sourced by where the service is? So if you're talking about lawyers and accountants, a lot of the lawyers and accountant services are not taxable in most states. There might be a few out there that do tax it, but again, you would want to be able to source, obviously look into what you're selling to them and where the benefit is received in those jurisdictions. Okay, someone has a question, Emily, I have a question about two-prong threshold, the 100,000 sales threshold and 200 transactions. If it is an and situation and you're a SaaS provider billing monthly or annually, how is the transactions threshold evaluated? Now, the transactions threshold, and it's a great question because there are a few states actually that have that. I know New York has the and Connecticut has it. There might be one or two more. But basically, if you don't have both, then you don't have economic nexus. Okay, so it's going to be very important to make sure you evaluate that. Now, what is a transaction? Generally, what's on the invoice that's considered a transaction. Okay, hopefully that answers your question. If an out-of-state corporation has economic presence, it is subject to sales tax for purchases used in that state. Yes, that would be absolutely correct. If you have economic nexus, whatever you're selling into that state, you would have to collect sales tax if it was taxable. If it's a tangible personal property, it's generally taxable. You would need an exemption certificate, or unless there's an exclusion for that as well. You could also use tax. Is online training taxable in New York State and New York? And that's from Gerald. Now, New Jersey's come out and said it's not taxable for now. They could change their mind. New York State, a lot of it depends on what type of training it is, if it's available, if there's interaction involved and so forth. Is it educational? There's a lot of things that go into it. It's going to be a very specific answer to what you're selling. Okay, so we generally look at contracts and then compare it to the law, and you may need a letter ruling from the state of New York. Okay, someone lost connection there. Allison, make sure you take care of that. Emily, SaaS is taxed on based on the end user location. If you generally tax your customers based on their location provided for billing, how much do you need to dig into end user information from practical perspective? Great question. And this could affect sales tax and income tax. But some companies have the ability to determine where their users are, or where their customers' users are. Others don't. So you might have to ask your customer where they're actually using it, and then get the proper documentation. Like some states have a certificate and others don't. So you want to make sure you're communicating with your customers. Okay, we can go move down. And Denise, do you know what report a taxpayer can use from Amazon to determine gross sales per state? There are reports in their system. I don't personally use Amazon, but I know our clients have reports that they use to determine gross sales per state for the year. You probably want to talk to your Amazon rep and find out how to use that, or look online. I think there's some in Seller Central. Depends on which documents you used. And we're going to stay on for a few more minutes, of course. Please clarify whether you believe Wayfair applies to income taxes. That's you, Jay.
Yeah, so it does, but it didn't need to, because pre-Wayfair, right, economic nexus was, you know, on many of the state statutes and being aggressively pursued, and Wayfair just solidified economic nexus for income tax. So yes, economic nexus Wayfair applies to income tax.
Okay, and then there's another question for you. I'm going to put our contact information up here too, so right here. But Jason, do you see this next question?
Yeah. So somebody asks if in regards to the Jeffrey, South Carolina case, if you have a remote seller of intangibles that has economic nexus in a state, are you advising your clients to file income franchise taxes in that state as well? So the answer to that is, if you're generating service revenues or intangible revenues, and it's being sourced to a respective state that has economic nexus, then yes, we would, that business, that taxpayer should be filing in that respective state. And most states at this point do have economic nexus provisions. So if there are material sales in that state, there would generally be a filing requirement. And then I think the next question, is income tax economic nexus states based on Jeffrey or something else? So essentially all Jeffrey is the first landmark state case after Quill that said, South Carolina ruled that you don't need physical presence in the state, that a form of economic nexus, form of economic presence in a state would establish nexus. It's just the first case. It happened right after Quill, and so it's often referred to. And then many states after that, over the next couple of decades, continue to pass even more aggressive economic nexus provisions on income tax. And so the Jeffrey case is just a South Carolina case, but every state has their own economic nexus provisions. Most states on the income tax side, they do have broad provisions that just say, if you're doing business in our state, you have nexus, and the way they'll define it in the regulations as doing business is essentially having any source sales in the state. And so that's often what's going to drive economic nexus. Is there economic nexus for income tax purposes for a company if there is just a remote employee working from home in state? So the answer to that is yes. You don't necessarily need an employee in a state to have economic nexus, because again, if you have a customer, so to speak, in the state you're doing business and you might never enter that state, then you're going to have economic nexus. Now, if you have a remote employee working from home in a state, in most cases, that's also going to establish nexus. Now, there might be certain COVID-19 relief measures for having a home employee, but that's a whole nother conversation. But traditionally speaking, having an employee home in a state from a permanent perspective is going to establish nexus. Let's see what else we have here. So I think these are just comments here. So somebody asked a question, my experience, who is the customer in the case of an insurance broker, the insurance carrier, or the insured? So these are all very good questions, right? It's going to come down to, on a state-by-state basis. Oftentimes we're doing analysis, right? Who is the customer? Right? You might have a contractual relationship with one party, but another party is ultimately getting the benefit of your service. And again, that's why it requires state sourcing analysis to, based on that revenue stream and based on that state, to take a deep dive into, what the sourcing position would be. So that's really going to vary. But, to answer the question, in some states, it could be either party. Somebody asked, what does a company do if they didn't think they would be over the state threshold for sales in state, but then go over it in the year? At what point do they start collecting once they go over? Jim, do you want to take that? Or I might have missed a question, but take that
sure.
one.
Yeah, I'll take that one, and you can do the one previous. But basically, a lot of states give you 30 days after you go over the threshold. Now, keep in mind the thresholds are different per state. Like, for example, you could have a $100,000 threshold based on the preceding calendar year. It could be the preceding 4 quarters, like New York is, and their off quarters. Or you could have consistently, like every month, if you go over it, then you need to register at a particular point. And a lot of states do tell you whether it's 30 days or so, but they do give you a little bit of time to register. Okay, Jason,
With that being said, before you jump and register, you should look at your total sales that you went over by and determine if you want to go for a VDA.
Hey, Jason, you want to answer the COVID question?
Yeah. Yep. So New Jersey has announced that, somebody wrote, New Jersey has announced that in the COVID period, it will not apply its doctrine that employee doing work at home in New Jersey causes the employees otherwise non-New Jersey employer to be doing business in New Jersey. Given that New Jersey uses single sales factor to apportion income and source sales income by the location of the customer, how does it matter whether or not the employer is doing business in New Jersey? So if I try and make sure I understand the question, I guess a couple of things here is that if you're a service provider, right, and you have source sales to New Jersey and you have economic nexus, let's say, right, the relief measures are not going to apply to that business because they would have otherwise had economic nexus in the state. Some of these relief measures for income tax, right, on the from a COVID-19 perspective, are if you now have an employee temporarily, let's say in New Jersey, right, and that's what's establishing the nexus in New Jersey, the state might provide a relief during that temporary period if that's what's generating the nexus, not the economic nexus. Now, New Jersey, from a payroll tax perspective, has provided some relief there as well. So hopefully that answers that question.
Okay, if a business is determined to have economic nexus for sales tax purposes, is it assumed they have economic nexus for income tax? Or is it determined? Go ahead, Jason.
Yeah, no, that's a great question. I would say most of the time, maybe I should rephrase, a lot of the time, not always, because for sales sourcing on income tax, if you're able to redirect those sales outside the state, you might get to a favorable answer. So assuming that, though, you do have sales, right? You still have the same revenue in the state for both sales tax purposes and income tax purposes, then and it exceeds the thresholds of sales tax, you most likely are going to have it for income tax, but there is some disparity in some states on the rules. So I would say most of the time, yes, but not always.
Okay, are subscriptions to e-newsletter or webinar taxable on the Wayfair ruling? Again, e-newsletter depends on the state, of course. Some states might consider it an information service of some sort, or might exempt it. We've had scenarios where it was an e-newsletter could have been considered a magazine or so forth, and which might be exempt in certain states. So again, depends on if you have Nexus on the particular state. And then the webinars, of course, you know, they could be taxable depending on the state, like I had mentioned. Some states could consider them digital, some could give it a digital product, which many states now tax. And to me, it's more of a stretch that they're trying to get that, but there have been rulings out there that have been very aggressive. Bonnie, anything else on that?
Right, and some states, it's very interesting actually. Some states try to analogize it to something tangible. These webinars and training sessions, so it varies by state.
Okay, I think that's all the questions that I see. Anything else you see, Jason, on there?
No, I think that's it.
Okay, so again, feel free to contact any one of us if you have any further questions. We're always available. Again, either phone or send us an email. You're more likely to get us if you send it to at least 2 of us. So, but again, thank you all for attending. It's always a pleasure doing these webinars. Thank you.
Thank you.
Take care, everyone.